Hello, everybody. Happy New Year and welcome to our 2026 January edition of our webinar. We have new year, new numbers, and our president and CEO, Deanne Rosso, is with us today to go over all the changes for 2026 that you can expect. And Deanne, welcome. It's so good to see you. So
Thank.
happy to have you with us today.
It's good to be here, Betsy. Happy New Year.
Happy New Year to you. Well, Deanne, I'm going to start us off by asking you, what is something new that you're listening to, watching, or reading right now?
Oh, good question. Well, one of my New Year's resolutions is to read more this year.
Mine too.
But I really haven't started that resolution so much yet as my son and I, for the last couple of years, have been reading through the Harry Potter series.
Oh, cool.
So we just finished book 6 and we are now starting book 7. So we're starting the last one.
Oh, that's awesome.
And I
That is,
think after this, he wants to transition to reading The Hobbit and the Lord of the Rings series. So I'm excited about that too.
oh, that's perfect. That's great. Well,
Mhm.
very good. Well, I'm going to let you start us off, and Deanne is going to go through our key financial data card that some of you are familiar with. For the rest of you who aren't, you're going to get a little walkthrough of it. I'm going to put a PDF of that card in the chat box so that you can download it. And then also, we're going to have some hard copies at our office. We'd be happy to send them to you. Just send me a note at marketing@elevate-wealth.com, and I'll be sure to get one in the mail to you as soon as they're available. All right, Deanne, I'll let you take it away.
All right. Thank you, Betsy.
Yep.
So, like Betsy said, new year, new numbers. And so today's webinar is really just an overview of what are the new tax related numbers for 2026 that you might want to be aware of. And we do this webinar every year because every year the numbers change a little bit. And I think it's just important information to know. There's a quote that I use a lot by Judge Learned Hand that, and I'll paraphrase, it's not the exact quote, but it is there are two tax systems in the United States, one for the informed and one for the uninformed, and they're both legal. So we want you to be on the informed side of knowing what you need to know in order to be most tax efficient in your personal situation. And that's where the numbers that I'm going to share with you come in today. Betsy did mention that she's posting in the chat box a copy of our key financial data card. I would encourage you to download it. It's great, helpful information. I'm going to share my screen with you now so that you can see that. And without prepared slides or anything today, all I'm going to do is walk through this card and the numbers that I think are important for you to know. And so without further ado, I'll just jump right into it. So key financial data 2026, and there's lots. If you're looking at this card and you're like, there's lots of lines, lots of words, lots of numbers, lots of black and white, I'm overwhelmed. So we'll just walk through each section. And instead of starting and reading like properly left to right, I'm going to start right here in the middle. And so as I go along, I'll highlight the section that I'm on. I'm going to start with standard deduction. So, when we talk about standard deduction, what we mean by that is the amount of money that you're able to earn and just deduct from your income without paying any tax on it. And so I like to think of standard deduction as this is the free amount of money that you get every year without having to pay any tax on it. So that's why I like to start with standard deduction. And this year, the standard deduction has gone up a bit. If you'll think way back to 2017, that is when the Tax Cuts and Jobs Act was signed into law. And what that law did was it did away with personal exemptions so that when you file a tax return, every person in your household gets an exemption. Instead of that, it increased pretty dramatically, doubling at that point, effectively the standard deduction for the households. And so now you don't get a standard deduction and a personal exemption, you just get a standard deduction, and that's been in effect for a few years now. And so this year, the standard deduction just for married filing jointly is $32,200. And for if you're single or married filing separately, your standard deduction is $16,100. So again, that amount that you can just take off your income right off the top and not pay any tax on it. And then skipping down a couple of lines, there are additional deductions for non-itemizers. So what does that mean? Well, going back to the standard deduction, you either take the standard deduction, which is these amounts listed on your tax return, or you itemize your deduction. And one thing that the Tax Cuts and Jobs Act did was it also minimized the itemizations or the things that are available to itemize. And so now we think about just a few things that are kind of our big itemized deductions, which are mortgage interest, charitable deductions, and state and local taxes. So if those three items and a few miscellaneous others, but those are the big three, if those items add up to more than the standard deduction, then you're going to itemize your deductions and get more than the standard deduction. But if they don't, then you just take the standard deduction and make your tax prep pretty easy and simple without having to track those itemized deductions. So that's the difference between standard and itemization. And then to go on to this second section in standard deductions, additional deductions for non-itemizers, or if you're taking the standard deduction. If you're blind or over age 65, each person gets an additional $1,650 that they can use as a standard with their standard deduction. So that increases that standard deduction for your household. And then one thing that was introduced last year under the One Big Beautiful Bill Act is the additional standard deduction for individuals age 65 plus. And that's $6,000 per individual in addition to the $1,650 and in addition to your standard deduction. So you get to stack all of those things up. Why did they do an additional standard deduction? And one of the reasons why is when the One Big Beautiful Bill Act was proposed, there's this misconception, when it was proposed, the idea was to eliminate tax on Social Security. But in effect, what happened was tax was not eliminated on Social Security. Instead, they gave seniors age 65 plus an additional standard deduction that would help offset that tax on Social Security. And in my opinion, I think this is a good thing. I think it includes more people. If your Social Security strategy is to wait until you're age 70, your Social Security will be taxable, but you get to start using this additional standard deduction at age 65. So it can be helpful strategy for you in that way. One thing to note on this additional standard deduction is it does phase out. And they're down here at the bottom on the right. There's a teeny tiny little phase out right down here. But the phase out for that additional deduction starts at $75,000 if you're single or $150,000 for married filing jointly. So just know that where that can catch you is if we're working on strategies like maybe Roth conversion, or you're still working and you have high income, then you may phase out and not qualify for that additional standard deduction altogether. So important piece of planning and something to note, something that we're looking at when we are recommending strategies to clients is this going to phase you out of the additional standard deduction? And is that worth it? We're going to run the numbers on that. So then we've also got child tax credit down here. If you have children in your household under the age of 17, then that's $2,200 and $1,700 of that refundable, meaning if you owed zero tax and then you had a child tax credit, that you could actually get refunded to you $1,700. So that's your child tax credit. And those also have a phase out. So that starts at $400,000 of joint income. So it's a decently high phase out for married filing joint situation. So that's your standard deduction. And why do I talk about standard deduction first? It's because standard deduction or your itemized deductions come off of your overall income to come up to your taxable income. And that's where we shift over here to the left and we talk about what are the tax rate schedules for 2026. And it's important to note here that this says taxable income. And that's because this is the amount of dollars you will actually pay tax on after your standard or your itemized deductions and your miscellaneous credits or whatnot, things that you may have. So we're still in a 7-tier system. We, in the US, have a marginal tax bracket system, which means you don't pay the same amount on every single dollar. And so if you are Single, your and 0 to 12,400 after your standard deduction, you have a zero base amount of tax, and then that marginal tax rate is 10%. And then just to give you an example of how that marginal tax rate works, go down to the next bracket. If your taxable income is between $12,401 and $50,400, then your base amount of tax is $1,240 because that's that 10% marginal tax rate in the first bracket, plus 12% of the amount over $12,400. And so on and so forth. And that's how the marginal tax rate system works. And then going down, I feel like I don't feel like I know that the amounts of taxable income that you're able to take in these brackets have been increased slightly over last year. So you have a little bit more income in the 10% bracket, a little bit more you can take in the 12% bracket, and so on and so forth. And those adjust with inflation. And so 22, 24% tax brackets, we often see those and up into the 32% tax bracket. And so what's the overall goal? Overall goal, right, is to be in the lowest marginal tax rate possible. And so, when we're doing planning, what we're thinking about is, particularly for income stream planning, retirement income stream planning, or even during your accumulation phase, what are the things that we're doing to keep your marginal tax rate as low as possible? Or how are we volunteering to pay extra taxes now because there might be some room, let's say in the 12% bracket or in the 22% bracket. And we are in still one of the lowest marginal tax bracket situations in that the US has ever been in. So it makes a lot of sense to try and utilize those tax brackets to your advantage, if you will. So again, those numbers here, going into married filing jointly, you can have up to 24,800 in the 10% bracket, up to 100,800 in the 12% bracket before we broach into the 22 or 24% brackets. And those numbers are after the standard deduction. There's, of course, other tax statuses. You might qualify to file as head of household, which means that you have dependents in your household. You're not married, but you have dependents in your household that you provide their support, and that would make you a head of household filer. We have married filing separately, and estates and trusts have their own tax bracket system as well. So that's just a quick overview of the tax rate schedule for 2026, what it looks like, and how we might use it when it comes to planning for your taxes for 2026. All right, now we're going to go right in the middle of the card. And we're going to look at tax rates on long-term capital gains and qualified dividends. Again, another planning item, because long-term capital gains and qualified dividends get sometimes better tax treatment than ordinary income. And so this is what that looks like. If your taxable income falls below, let's call it $50,000 and you're single, or $98,000 and with a joint filer, then taxes on your long-term capital gains are zero. You owe no tax on that long-term capital gain or qualified dividend. If your taxable income falls at or above 49,500 and single and 98,900 joint, then that's a 15% tax on long-term capital gains and qualified dividends. And then if your income is above, and this is a big gap here, if your income is above $545,000 single or $613,000 joint, then it's a 20% tax on long-term capital gains. So what makes that beneficial? Well, let's think about it for a minute. If your income falls at or above, let's call it $545,000 single. If we go back over here to our single tax bracket, what are we paying for ordinary income at that same level of income? We're paying 35%. So that is a 15% savings in tax if we're taking capital gains versus taking something that's ordinary income. And what do I mean by ordinary income? I mean wages. I mean interest, short-term capital gains, income from things like 401ks that are pre-tax, IRAs, traditional IRAs, those types of annuities, pension payments, those types of income streams are ordinary tax rates. So again, planning item, how do we plan to shift more income into the long-term capital gains and qualified dividends rate system versus an ordinary? And you might be thinking, well, my income is never going to be above 550,000 or 613,000. And that's okay, because on the flip side, what if we can keep it down low so that it's a 0% tax or a 15% tax, as opposed to going over here to the single tax rate schedule again, or even married filing jointly and looking at the 22% bracket. It only takes 50,000 of income to be in the 22% marginal tax rate, where if that income is cap gains or dividends, your qualified dividends, you're paying 15% versus 22. And then same thing for married filing jointly. For a married filing joint couple, that 22% bracket begins at $100,800. And so I think an important key to keep in mind when thinking about your capital gains and qualified dividends and this rate schedule is the fact that the capital gain or the dividend itself counts as income. So let's use a very simple example of that. If taxable income falls below $49,450 and you're single, well, that includes the capital gain that you just took. So if you had $25,000 in capital gains and you had $40,000 in ordinary income, you've actually now jumped up to the 15% tax bracket for capital gains. And that's because your total income is over 60,000. And so you have to be aware that that's a cliff, that once you go $1 over that taxable rate, that it goes to the next capital gains tax level. So you have to be careful about that in your planning. But this is a really, really special section and huge for doing some tax planning for, retirement income streams, or, while you're working and you need to take extra income from somewhere. All right, so moving on, the next section, the 3.8% tax on the lesser of net investment income or excess of magi over. This doesn't hit a lot of people, but it does for a few. Let's say that you had a larger than normal tax event in the year, or you want to do some really high Roth conversions or something like that. This can this is what's called the Medicare tax, and it's 3.8%. So if you're married filing jointly and your net investment income or the excess of your modified adjusted gross income is over $250,000, then there's an extra 3.8% tax. And if it's over 200 for single or 125 for married filing separately. And again, doesn't impact a lot of people, but when we're doing the planning for things like Roth conversions or taking extra income, or you sold a big piece of property, this year with really, really low basis has had a really big gain, that 3.8% tax can hit you and can be a surprise. So I think it's just important to know that it's there if you anticipate having a high income in 2026, so that we can do some planning strategies around that. Either just plan for it, or what are some other things that we could do to potentially offset or lower that income for the year. All right, I'm going to move on to the right side of this card, gift and estate tax. I get a lot of questions about gifts and estates and how much can I give. And so this is just a really quick overview of that. I'll start with the gift, this third line here, the gift tax annual exclusion of $19,000. What this means is any individual can give any other individual they want $19,000 without having to report that in any way, shape, or form. So one way that we do some planning around that is if someone is looking to lower the amount of their estate, you can make gifts to your children, your grandchildren, your cousins, your friends, whoever you want, $19,000 each for that year, and not report it at all in any way, shape, or form. Now, where this comes in is in this estate gift and GST exclusions of $15 million. And what that means is that when you die, you can leave $15 million tax-free to your estate. And spouses can double that. They effectively double that to $30,000. And there's a certain strategy you have to use in order to make sure that the first spouse uses their 15 and then the second spouse has the what's left, the remainder of the first spouse's 15 million. And that's topic for another day. But the point is, it's a very high amount that we have now to leave to our families without any federal estate tax. This is federal only. Probably should have said that at the beginning of this presentation, that all these numbers are federal only and state taxes do still apply and for whatever the provisions are in your state. But at the federal level, you can leave $15 million to your heirs tax-free. So what does that have to do with the gift tax annual exclusion? Well, let's say that I gave $20,000 to another individual instead of 19. That's over the annual exclusion amount. That means I need to report that $1,000 on when I do my tax return as a gift. And that $1,000 is going to go against the 15 million that I have to leave at the end of my life. And so any additional gifts that you give over the annual exclusion amount reduce the amount of your final estate exclusion. So that's how gift tax and estate tax exclusions work together. You keep it under 19, and people will ask me all the time, like, well, I can't give more than 19,000. Sure, you can. It'll just go against the 15 million that you have to leave later. And that's okay for most people, generally speaking. And so it's not really that big of a deal. It's just another line item or a form to include on your tax return. So the next section on this card is highlighted way too much there. The next section on this card is education credits, deductions, distributions. If those things apply to you there and to your family, there are these credits, deductions, and distributions for education. So what does it look like for the American Opportunity Tax Credit, the Lifetime Learning Credit, savings bonds, using those interest tax-free, a Coverdell account, and then we've got 529 plans in here. And so there's so many different types of credits and different types of education accounts. My hope is that, for our clients at least, and when you're working with your advisors, that you're making the best choices for education, savings and planning and credits, because there's just a lot of different options that with lots of different income phase outs and who qualifies and who applies and all those kinds of things. And so I would encourage you to just look on this chart and then consult with your tax professional and your advisor to see which types work best for you. And then we have a nice handy dandy little schedule here. So you don't forget what the tax deadlines are for 2026. And of course, we have estimated tax payment deadlines if you fall into that category of folks who pay estimated taxes and why do we pay estimated taxes, right? We pay estimated taxes because the IRS requires that we pay our tax throughout the year rather than dump it all in at once. It wasn't always like that. Back historically, it was you just paid tax once a year. And actually there was some rule about it being around your birthday, which is interesting. But now the government likes to get their money paid to them throughout the year, much like we like to get our paychecks regularly. And so January 15th is the fourth installment of last year's estimated taxes that are due. And then as far as estimated taxes go, you've got June 16th, September 15th, and October 15th this year for making those estimated tax payments with your January deadline next year, your last one for 2026. And then other important things to note. So there are some types of retirement plans that you get to wait until April to make the contributions that would still qualify for last year. So April 15th is your tax filing deadline. That's the request to extension of an extension to October 15th if you need an extension. That's your first installment of your 2026 taxes are due. That's your last day to file an amended return for 2022 if you need to go back and amend. That's your last day to contribute to Roth or traditional IRA for 2025, for health savings accounts for 2025, for KEO or SEP plans for 2025, unless you extended your return on the SEP plans or the KEO plans, but SEPs are more common. So April 15th is a big day, as we all know, but it's not only just the tax filing deadline, it's the deadline to do all those things. And you can even do a little retroactive planning, if you will, when you get your preliminary tax return done. If you didn't make a traditional IRA contribution or a Roth IRA contribution or an HSA contribution, you have time. You have until April 15th or the day you file your tax return. So if you file on March 15th, that's actually when those contributions are due. So just know April 15th is the last possible day to make those contributions. But you could effectively make an IRA contribution and lower your taxable income. If you didn't already make one for 2025 and you qualify, and that's helpful to lower your tax bill. So there's still time for those kinds of things. All right, and that's your tax deadline. So that's the front page of the card. And guess what? There's a back page. So let's go on to page 2. And a few less things on this page, but perhaps this is probably the side that I look at almost every single day. And this card has been a constant companion for me. Actually, as I was preparing for this webinar, I was looking back, and we've been using these key financial data cards for about 15 plus years. And I was looking back at all my different iterations and how numbers have changed over time. Yes, because I am that kind of tax nerd. But I have this handy reference at my desk, and I use it in almost every single client meeting. And for those of you who are clients of Elevate, you'll know now that I stash a copy up underneath my placemat at the conference table so that I have it ready to whip out at a moment's notice. So let's talk about retirement plan contribution limits. This one is key for a lot of people, and there are a few changes to this year. So let's skip on down. Actually, I'm going to unhighlight some of this and just highlight the parts that I want you to look at. So 401k plans, one of the most common retirement plans used in America, 401k, 403b, 457, Roth 401k, they're all defined contributions. And this year you are allowed to contribute $24,500 of your salary into your 401k, 403b, 457. And that is an increase over last year. So if you haven't already, and you typically maximize your employee salary deferral contributions, you might want to log into your plan or get with HR and increase that amount if you want to maximize. The next line is the catch-up provision, and this is a little bit that's changed this year. That catch-up for individuals age 50 to 59 and 64 plus. You'll notice there's a few years missing there, and we'll get to those in a minute. But in those 401k, 403b plans, if you're age 50 to 59 or 64 plus, you can make an additional $8,000 catch-up salary deferral contribution. And this year, starting this year, if you also are age 50, 59, 64 plus, or actually if you're just over age 50, and you want to make a catch-up contribution to your 401k plan, and you're considered high income, which is defined as if last year your wages from that employer were $150,000 or more, then your catch-up has to go into Roth 401k. That's new, rolling out this year. One of the provisions of the Secure Act 2.0 that came out a couple of years ago and becomes effective in 2026. So if you've gotten notifications from your employer about how you can establish a Roth 401k, or maybe you need to, or I know plan providers are actively working with a lot of their plans, or working with a lot of our plans to make sure that that Roth provision is in place for people who want to always do a catch-up contribution and they're over those certain ages and they're over $150,000 in wages. Those contributions will have to be made via Roth, which is built into that. It should be a provision in the plan. All right, so that's, again, going back to the catch-up for age 50 to 59 and 64 plus. So where are those other ages? And that's where we come to the next line, which is the catch-up provision for individuals age 60 to 63 in your 401k, 403b, 457 Roth 401k. And this is what has been dubbed the super catch-up. So also rolling out this year is an additional catch-up provision. So instead of $8,000, you can put in $11,250 as an extra way to help you catch up if you're age 60 to 63 this year. Again, same provision applies with if your income is considered high, over $150,000 in wages, then that has to go into the Roth part of your plan. But it's just that way that individuals those ages can get a little extra bump in what they're able to save. And why do they do this? I don't know the exact reason why, but being a planner as long as I have, my gut feeling about this is because this is a point in time for a lot of families when children have finally grown up, graduated, maybe left the nest, and families have been paying for lots of expenses, particularly college, up until this point. And it just gives people in that window the ability to save maybe some of that extra discretionary income that they have now, or just maybe that point in their career. So I would highly encourage you to take advantage of this. And even if your income is high and that catch-up has to go into a Roth, that's really great, because in a minute, we're going to look at what the Roth contribution income limits are. And if you're a high enough income earner where you're over the Roth contribution limits, you can still do Roth 401k. The income limits don't apply in a 401k plan. So even for your salary deferral, I might encourage you to switch some of your elective deferral amount into Roth. And if you're high income, all of that catch up goes into Roth. And that will be a really, really great thing for your retirement income later. It'll just hurt a little bit with the tax bite right now. So, all right, so that's 401k contribution limits. And then if you have a simple IRA plan, your elective deferral limit this year is $17,000 in what you can contribute from your salary. And then there's a catch-up contribution for ages 50 and over of $4,000. So those are your retirement plan, your employer retirement plan contribution limits. What about IRAs? So let's go on down to this section now and look at what's our limits for IRAs this year. And so with your let's look at traditional deductible contribution. You can make $7,500. And if you're age 50 plus, it's an additional $1,100. Love that there's an extra $100 in there this year. It's going to throw my math totally off all year, but that's okay. It's an additional amount that age 50 plus can add to that IRA for this year. Now, there are limits, income limits for a traditional deductible IRA. And what I mean by that is if you make your contribution and you want to deduct it on your tax return and make sure it's in there pre-tax, then if you are covered by an employer retirement plan, your income needs to be less than $149,000 joint income in order to make that IRA contribution deductible. And then there's the numbers for single head of household, less than 91,000. Married filing separately, you really don't get a huge break with a lot of things, actually. If you're married filing separately, your income limit is very low, only $10,000. It's actually $0 to $10,000. So you really don't get a break at all if you're married filing separately. Now, if one spouse is covered by a plan, that income limit is higher. It's up to $252,000 joint income. So this is where we see the use of a traditional IRA, a deductible contribution done effectively when one spouse is a higher earner, has a 401k, and another spouse is not covered by a plan, then that income limit is higher to allow actually both of them to contribute to the traditional IRA. Okay. And I skipped over traditional non-deductible, but the reason that I did that is because if your income limit, if you reach those income limits and you can't contribute to a deductible traditional IRA, let me back up. If your income is over the contribution limit amount, then you can still contribute to an IRA. It just becomes a non-deductible contribution, meaning you can't deduct it on your tax return and you don't get a tax break. What you do get when you make an IRA contribution is you don't, let's say that $7,500 you put in, it's not, you don't get to deduct that on your tax return, but the growth on that, as long as it's in the IRA account, will be tax deferred until retirement. So there is still a benefit to contributing to a non-deductible traditional IRA. And also, if you do that, you need to keep up with your contributions. There's a form in your tax return that allows for reporting those non-deductible contributions, because you need to know how much went in it over time that wasn't deductible, because that effectively becomes your basis, how much you put into the IRA that you can take out without tax. But every dollar of growth or earnings on that IRA is going to be taxable going forward. Skipping down to Roth. So Roth, one of our favorite types of accounts. Don't get a tax break on it now, but it grows tax deferred. And then we pull the money out in retirement, it's completely tax free. All those growth dollars, completely tax free. So we love Roth IRAs. But one thing we say about them is it's kind of hard to get money in Roth. Easy to love them, hard to put money in them. And why is that? And that's because of the income limits, typically, or just because it feels better to get a tax deduction now. But this year in Roth, you can put in $7,500, and that catch up for age 50 plus is $1,100. And if your joint household income, married filing joint, is $252 or less, you can make a Roth contribution outright. $168,000 or less for single and head of household. Again, married filing separately, don't really get to do this. But it's really, it does feel really, really good when we have the choice between traditional deductible and Roth IRA to put the money now in the traditional deductible, because we get a tax break on that now. But man, it feels way better in retirement when we've got a nest egg built up in Roth IRA that we can pull from without any taxes at all. So that's a planning item. For your situation individually, what makes most sense. But general rule of thumb, try to get as much money in Roth as possible to accumulate for your retirement. And then the last thing on Roth here is Roth conversion. What do I mean by Roth conversion? I mean moving money from a traditional IRA over to a Roth IRA so that you don't pay tax on the Roth IRA money ever again. But what we do in that transition is we pay tax. So if we move $10,000 from a traditional IRA to a Roth IRA, we pay ordinary income tax on that $10,000 transition. But then the tax is prepaid, if you will, and it's allowed to grow in the Roth for the remainder of your time, and you can pull that out tax-free later. So Roth conversion, there's no income limit. Anybody at any level of income can do Roth conversions without worrying about phase outs or income limits. It's just taxable when you do the conversion. All right, a couple of things I'll hit on really quick while we're on the left side of the card. Health savings accounts. Other than a Roth IRA, this is the absolute best type of account when it comes to taxation. And that's because it's completely tax-free. Money in is tax-free. Money out is tax-free as long as it's used for medical healthcare expenses. But again, one of those accounts is hard to get money into. Not unless you have an employer. And one of the reasons I say it's hard to get money into it is you do have to have a high deductible health plan in order to have a health savings account. So that's what makes it hard. It's actually easy to make the contributions. It's just you have to have a health insurance plan that's high deductible and that qualifies for an HSA. But your maximum contribution this year for individuals is $4,400. For families, it's $8,750, and there is a catch up for each individual over age 55. It's $1,000 each. And so, again, fantastic account to have to save for your retirement. And one question I get sometimes about HSAs is you can't have one once you go on Medicare. Let me back up. You can't contribute to an HSA once you're on Medicare. But if you already have the HSA and you have money in it, you can use that for Medicare or supplement premiums. So that's one just planning tip that we use for retirees is once you get to Medicare, let's try to pre-fund that HSA so we have it available to use for premiums in retirement. Long-term care premiums, we talk a lot in our classes of things we teach here and with our clients about long-term care. What's your plan for long-term care? There is long-term care insurance that you can buy. And just know that part of that premium is deductible as a healthcare expense. And this chart highlights by age what amount of long-term care premium is deductible. The catch here is that it qualifies as a medical expense. And so when you have to itemize your deductions and your health expenses have to be an itemized deduction that is over 7.5% of your income. So a lot of people are able to take the health expense deduction because their health expenses out of pocket are just not that much. But just important to know that some of that premium is deductible if that's your situation and you have long-term care insurance. All right, we are rounding out to the last 2/3 of the back side here, and I'll kind of quickly move through it. When I mentioned earlier that Social Security tax had not been eliminated, in the middle of this card, we have, well, how much tax am I going to pay on my Social Security? And that is based on your provisional income. And if I look way down here in this teeny tiny writing, there's a definition for provisional income. So basically, you take your adjusted gross income, not including your Social Security. So take out your Social Security, add up all your other sources of income, plus any tax exempt interest. So if you have like muni bonds that generate tax exempt interest, and then you add back half of your Social Security benefit. Could it be more confusing? But that is your provisional income. And that, to go back up here in the very center of this card, is what your tax on your Social Security benefits is based on. And these numbers have not changed in a long time. So if you're married filing jointly and your provisional income is under $32,000, then you pay nothing on Social Security. You pay no tax on your Social Security federally. If your income is $32,000 to $44,000, your provisional income, then you pay up to 50% tax, or up to 50% of your Social Security is subject to tax. And then if it's over $44,000, up to 85% of your Social Security amount is subject to tax. And then similar, it's same 0, 50, and 85% amount that's subject to tax for single filers. The provisional income is a little different, under 25,000 or 25 to 34,000 or over 34,000. So, you may ask, like, how is it even possible to have provisional income that's under 32,000 and have zero amount of Social Security tax? And my answer to this is a lot of pre-planning, because this has to be a designed savings plan so that later on when you're pulling out income in retirement, your provisional income, which, remember when I said earlier that Roth IRA income is never taxed again? So it's basically a zero. It's not included in your adjusted gross income. So if we can shift a lot of savings into Roth, then we can set you up in a way where Later on down the road, you won't pay any tax on your income or on your Social Security. But again, it takes a lot of thought, a lot of pre-planning. And I know this sounds like a plug, but that's what we're here for. That's what we help our clients do. And sometimes it's just not possible. The other thing in going through all of these things is to say, sometimes we don't let the tax tail wag the dog. We have a lot of other considerations other than just taxes when it comes to your retirement income planning. And so, but it's just important to know what type of tax you can expect on your Social Security. Okay. And then the last two things I want to touch on today are on the right side of the card. So Medicare premiums. Once you hit that wonderful age 65 and you're able to sign up for Medicare, it is not 100% free. Now, Part A is free, and that's what you paid for in your paycheck all these years in those FICA taxes, those payroll taxes that are deducted from your paycheck. Part B, though, has a premium associated with it. And so your premium is based on your modified adjusted gross income. And not only that, but it's based on that MAGI from 2 years ago. And so this is another planning item because we want to make sure that we understand what is your MAGI this year so that 2 years from now we have a really good idea what your Medicare premium is going to be. And so if your joint income is $218,000 or less, or it was in 2024, then your Part B premium is $202.90 this year per person, and there is no adjustment to your Part D. But if we go up into that next tier, and this is called IRMA, Income Related Medicare Adjustment Amount, IRMA, and we call these IRMA tiers. So this is a cliff tier. So if your modified adjusted gross income from 2024 joint income was $218,001, then your Part B premium goes up to $284.10 a month. And your Part D income premium, your adjustment goes up to $14.50 a month. And that's per person. So if you're joint, then that's effectively doubled. And so on and so forth. The premiums, the tiers go, next tier is $274,000 for joint, $342,000 for joint, $410,000 for joint, and then greater than $750,000. And so it's just important to know this really catches people off guard, probably more than anything else. If you have a year, when you're age 63, I'll give you an example. Someone who retires and gets paid out their paid time off, and maybe gets a some type of retiree bonus, or they get their bonuses paid out, or they get salary for half a year, or whatever it is, and that last year is just a really huge amount of income, and you're age 63. Well, 2 years from now, that's going to show up in your Medicare premium. If you're going into this IRMA tier, if your income goes into a higher IRMA tier. So that's something that we just want to plan for. Now, there is a way if you have a life-changing event, to basically ask the Social Security Administration, who administers Medicare, to reduce that premium back to what your income looks like today. But you have to have one of the qualifying life-changing events, and one of those is retirement, death, disability, and there are a few others. But just to know that if you have something like, I sold a big piece of property and I had a huge capital gain and that caused my income to be higher in 1 year, that's not an exception. And so your premium is just going to be higher. But the good thing is it's only for 1 year. And so that's another planning area where we can think about, okay, is doing this and this affecting my Medicare premium worth it, or should I hold off or wait, or is there just no choice and I'm just going to accept that my Medicare premium is going to be higher in that year? All right, last thing that will round out, and it's a good thing because I've been talking for a long time, but this uniform lifetime table is how you calculate required minimum distributions from accounts like your IRA or your 401k. And so as we know, once we get to the age of 73 or 75, depending on the year you were born now, you have a required minimum distribution on IRAs and 401ks. I'll summarize it at that. There's a few other types of accounts, simple IRAs, SEP IRAs. You're going to have required minimum distributions on those. So this is how you calculate that balance. You find your age on the Uniform Lifetime Table. So if you turned 75 this year, then you would look back at your, I'll use IRA as an example, your IRA balance on December 31st of 2025. So the prior year, whatever that balance is on that day, and then you would divide it by the life expectancy in years. So divide your IRA balance by 24.6 if you're age 75 this year, and that's how much money you must take out of your IRA without incurring penalty. The penalty for not taking your required minimum distribution has been reduced a couple of years ago to 25%, but still, you don't want to have to pay a penalty of 25% just because you didn't take the distribution. And so because then you still have to take the distribution and you still have to pay tax and you still have to take the penalty. And so it's really a great idea just to keep up with your required distributions. And again, some of the things we help our clients think about, how do we work to reduce those required distributions over their lifetime, or how do we use those retirement distributions for other things like qualified charitable distributions, which is when you can give money to a qualified charity from your IRA directly and not pay tax on that distribution, and that would count towards your required minimum distribution. Okay, that's a lot of numbers, but I hope it made sense, and I'll pass the mic back to Betsy and see if we have any questions.
Thank you, Deanne. That was so informative as always. Really, really appreciate you walking through this with us. And as I mentioned, I can send this hard copy out to anybody. So send me an email at marketing@elevate-wealth.com and I can make sure you get a hard copy. If you don't see it in the chat box, just click on chat and you should see a PDF in the chat box so you can download it and at least have that version until we can get you the hard copy. If you do have a question, please put it in the chat box or in the Q&A box. And in the meantime, while I'm waiting for those questions to come in, I just want to walk you guys through a couple things. We do have a YouTube channel, and all throughout January, we've gone back to basics with questions such as what is the standard deduction, things that Deanne went over today. So be sure to look at YouTube and look for Elevate Wealth in Athens, Georgia, and you'll see all kinds of tax questions and answers this month and next month. And I did want to mention, Deanne, do you want to talk a little bit about our addition of Ben to the team and his role and what we're doing with him this coming year and beyond?
Sure, that's a really good point. So this year, we added a gentleman named Ben Hall to our team. He is a CPA, an advisor, and a tax planner. And you know, we get asked a lot, like, why are you talking about taxes? You're financial planners. Why are you talking about taxes? And it's because taxes make such a huge impact on your overall cash flow, your income. And it has a huge impact, particularly in retirement, when we're thinking about all the things that we can focus on. We often in our office say, focus on what you can control, and we can't control what the markets do. We can put you in the best place for success as far as investment returns go. But one other area that we can focus on is taxes. And so we brought Ben onto our team as our director of tax services, and his role is to look over accounts. We look over tax returns. We are not Ben is a CPA. The rest of us are not CPAs. But we wanted to bring that to our clients. We also are offering tax prep, so to prepare your tax return. And so for some of our clients that may make sense in their situation, we can do also your tax preparation as well as your tax planning. And it's just such a big emphasis for us at Elevate that it was important now to have Ben and have someone dedicated in that role to focusing on what are the things that are most important to our clients when it comes to tax planning.
Excellent. Thank you for explaining that. And then Ben will be doing our webinar next month on tax planning. So be sure to go to our website, elevate-wealth.com. And there you can click attend a webinar and you can sign up for next month's webinar as well as all of the webinars for the rest of the year. Deanne, we do have a question. Does your taxable income in the tax rate schedule include your Social Security?
It includes the amount of Social Security that is taxable.
Okay.
Does that make sense? No. Okay, so going back to page 2 here, this amount of Social Security that is subject to tax, this is where sometimes the formulas for what income is, sometimes it seems like a circular formula because going down again to that provisional income, it's your adjusted gross income. So take all your other income sources. Let's say that I'm retired and I have a pension and I take a required distribution from my IRA and I have Social Security. So I'm going to take my pension income, I'm going to take my IRA income and add those together. If I had tax exempt interest from muni bonds, I'm going to add that in there. And then I'm going to take half of my gross Social Security benefit and add that. And that's my provisional income. And that's what tells me that, let's say, 50% of my Social Security amount is subject to tax. Then you take that gross amount of Social Security, half of that, and that is what is in this taxable income on the tax rate schedule.
Does that make sense? Just shoot a quick note in the chat box if it does. And if not, we'll get you and Deanne on the phone together later. That was all the questions that popped up right now. So Deanne, thank you for answering those. And then I did want to also mention, because this is coming up pretty quickly, we do our retirement planning today course several times a year. And our next one is coming up in February, and it is held at the University of Georgia. We're also adding one in March in Hartwell for anyone that's located closer to that area. But it's a 2-day course and it's 2 consecutive weeks, 3 hours each night, each evening from 6 to 9 p.m. So our next one is going to be a Tuesday class and a Thursday class. So the Tuesday class will be February 10th and 17th at the University of Georgia. And the Thursday class will be February 12th and 19th. And then we also have one coming up again in Hartwell. So if you'd like more information on that, I'm actually just going to go ahead and share the link to register for the Athens class in the chat box right now so that you all have that as well. And then if you have any other questions, just feel free to email marketing@elevate-wealth.com. And we had a very nice note from a client that says, great way to kick off the new year, most helpful identifying the variety of things tied to the April 15th deadline, in addition to the tax filing update. I love the chart. I've used and shared it with family and friends. So thank you very much.
Awesome. Well, I'm glad to hear that. And thank you. And again, we're happy to share it with anyone who needs it or who would like a copy of it. And one other thing I'll throw out there is, as Betsy mentioned, we have a YouTube channel. We do lots of education online. And if there's something that is of interest to you or you'd like to hear from us, either comment to Betsy in the chat box or send us an email. We're always looking for what's relevant to you and your life and your situation, and always looking for ideas. So let us know what you'd like to see.
Thank you, everyone, for tuning in. We'll look forward to seeing you next month for our tax planning update with Ben, and you'll get to meet him. So thank you very much. I hope everyone has a great rest of your week. Thanks, Deanne.
Thanks, everybody.
Bye.